All righty. Well, Ellis, welcome to the show, my friend. Excited to have you here.
Kevin, great to be on, man. It's about time.
Yeah, for those that don't know, let's just back it up a little bit. I gave you the brief introduction there, but I know there's a little bit more to your story. So, how about you take a few minutes for those that aren't familiar with you, don't know you, your background, where you came from, and tell us a little more about yourself.
Yeah, I'll be really short. Today I serve as the vice president of capital at Aspen Funds. We're based here in Kansas City, and we manage about 600, $700 million of assets. We have about 800 accredited investors that we serve and their families. But I started my career actually in college ministry. I was a campus pastor and loved what I did and never thought I would really do anything different. My first investment was a duplex in San Diego, California that we bought for $540,000 maybe. We sold that deal 3 years later for over $1 million, and I was hooked on real estate. So that was kind of our journey in foray into real estate investing, and then um, transitioned out of full time ministry into entrepreneurship. And over the years, we built a multifamily portfolio with a different company, and we still manage and own about 800 of those units today. And then, yeah, recently, like I said, I joined with Aspen. I love the story of Aspen Funds, which we can talk about today and what we're doing here, but really saw an opportunity, a growth path for me personally, but also just the opportunity to build upon something big, what Aspen's been doing over the last 12 years. So we joined to help grow and expand that. So that's a little bit about me.
Yeah, no, good deal. I appreciate that. Let's keep it in the beginning a little bit because I just want to build the foundation, the framework here. Let's talk about that first deal, right? That's what really set it off for you. That was the trigger
Yeah.
moment. What year was that? Just curious.
2017, maybe.
Okay, so 2017, good timing in the marketplace, right? Things are still going up in an upward trajectory. I guess what was the original plan with that deal? I mean, was it a deal that actually was going to provide cash flow on a monthly basis, or was it more of an appreciation play? I know California can be a little
A
tricky
little
as
bit
far
of,
as finding, things that actually cash flow with
yeah.
some reasonable leverage in place.
Yeah. Surprisingly, we were definitely covering our mortgage. I mean,
Mhm.
so we decided, this was like, we'd just gotten married, dude. So we'd been married 6 months, and I remember finding this deal. And we're thinking about we were supposed to just renovate it, and then like I didn't know much. I mean, I was a college pastor, okay, so I did not have a whole lot of real estate knowledge. And so the banker called me and said, "Hey, you have to put 25% down if you're going to buy this as an investment opportunity." I'm like, "Well, that's going to be an issue because I don't have 25%." So I was like, "What else can I do?" He's like, "Well, you can move into it." And so I remember laying down in bed. It was like 10 o'clock at night with my wife. And I was like, "Honey, I think we should move into this deal, this like complete rehab." And that was an early marriage experience of what not to do. But yeah, I mean, it was a fantastic opportunity. We ended up living in it, and we paid discounted rent in a sense because the other tenant was paying majority of the mortgage. And then once we renovated that deal, we started Airbnb one of those units, and then long term, and then long term rent. And then we actually living in both sides. So yeah, it did actually provide a lot of cash flow for us. The Airbnb covered the mortgage, and then we lived kind of rent discounted, or some months even rent free in that duplex for several years there in San Diego. So it was a great deal for us.
So house hacking, which didn't really have its own identity up until probably like Bigger Pockets came around.
Yeah. Yeah.
Good deal. No, that's awesome. How'd your wife handle that? I mean, just was
She
she
was great, man.
excited? Was she
I think
skeptical?
it was a good entry into like this is the guy that I married, because we the ups and downs of our entrepreneurial journey, that was the start of it. And so I think it was it was really great. I will never though, I will never after doing it twice, I will never, and I would like to all the married or newly married people out there, like never, um, I won't renovate the house that we're living in again. Like I won't do that again with my wife. That was
So you were
not
living in it while you were doing the
for the
renovations.
most part. Yeah, yeah, yeah. So we won't do that again. Yeah.
Yeah, that's a big pill to swallow. So, well, good deal. I'm sure she's happy about the decision that was made, right? Sounds like you
Yeah.
guys did quite well when you exited out of that. So, what was the next step? I mean, like you owned that for a couple of years, and ultimately at some point, you went further down the path of your education, learning about real estate investment because that was really the trigger. But I guess what did the next step of your journey look like jumping into, I know the multifamily space is where you kind of really where you hung your hat for a number of years. So what did that transitional point look like? How'd you educate yourself? And just give us a better sense of that journey.
I just got obsessed, man. Honestly, I remember like everywhere I would go, I started listening. I mean, your show, everyone, I mean, it just was consuming all types of content and just trying to learn about this real estate space. And a guy had called me that maybe I had been networking with. It's like, hey, did you know that you could raise capital and start, you can raise other people's money and buy bigger deals? And so that's where I learned about syndication. And um, so it took about a year to kind of, I did like a small co-GP deal with one other guy about 9 months after that. And so we put together kind of an apartment building via syndication. I brought a little bit of money and we were kind of partnering up on the deal. And that was like the light bulb moment of like, oh, okay, I see it now. Like if this is how I can really grow and build a portfolio, even though I don't have a lot of cash or capital behind me. And so that's really what we did. We started building a business plan around that. It took about a year to kind of transition from full-time vocational ministry into the world of entrepreneurship. And we started building a business. And our next deal was in San Diego. We bought a 20 unit apartment building there in San Diego, which we still own today. And, we did a lot more deals after that, kind of either as lead sponsor or co-GP model for most of those deals over that time span.
Talking about getting the traction. I mean, I know you're VP of capital over at Aspen Funds here today, but I do want to spend a little more time on your experience as an investor because what you learned kind of running your own investment shop really helped you transition over to the role that you're playing now with Aspen Funds. And so I guess would love to get a better understanding and also offer some value to the folks that are tuning in. It might just be, maybe they're opening up their own investment shop. They're kind
Yeah,
of in the, I'm excited about this. I kind of have my target as far as an asset that I'm going to go after, but raising capital, I think is a big hurdle for a lot of folks, right? Like, so talk to me
totally.
about, building your brand, your network and getting folks to trust you and kind of follow along with you in that journey and invest alongside you.
Yeah, I started another company around this time because I realized really quickly that, buying large real estate deals weren't, I guess there's fees and stuff, but it wasn't, it was more of an equity business.
Mm-hmm.
It's like, I need a cash flow machine. And so, we built another company and really was more of a community. And this is what coming from the ministry background, this is what I was good at. Like we built a ministry building communities on college campuses, right? And so that's what I love to do is just build community. And so I think that's what a lot of capital raising is. It's finding about, it's finding about creating what are you passionate about other than real estate? And who else is passionate about those things, right? And so that was something I don't know if I intentionally knew that at the beginning, but once I figured it out, I really went all in. And so there was a community I started called Kingdom Capitalist, which was a real estate community for Christian real estate investors. And I actually just continued to grow and grow and build upon that platform. And honestly, I probably was the one, if not, I was probably number two or number three kind of largest platforms in terms of content and following an audience in the Christian real estate investing space. There's maybe because there's not that many, but it was a pretty big following. Like we had a pretty large audience kind of recognized across the nation. And that really gave me a platform. And I would say, and a rep, respectability, going to, and I would always say this, like when I'd go on these podcast shows or I'd go to a real estate conference, I'm not the most sophisticated person in the room. I'm not the most experienced in the room. I don't have the biggest track record in the room, but the thing that always separate me is just my focus on the audience of who I serve and who I was speaking to. And so if I would go and speak at a conference and there's 1,000 people there, for example, I may not get the 800 or 900 people, but I may find a group of 50 or 60 people there that really want to
Mm-hmm.
talk and work with me because of our shared experience, right? Because of my experience as a pastor and now as an investor and my desire to, um, build wealth for eternal purposes, right? So that even the language we were using. And so if I tried to speak to everyone, I would have not been trusted because I can't speak to everyone. But I'd never really tried to be more experienced or, fake a track record. I just was me. I was honest. This is who I am. This is my story. This is why I'm building this. And that really attracted a lot of people. And I would always say this, if you're trying to raise capital, your brand or your message should attract the right people and it should repel the wrong people. And so
Mm-hmm.
I was and still am very open about my faith and who I am. because I think it attracts the type of people that I want to work with, and it repels the type of people that I don't want to work with. And that's the best advice I can give to someone who's raising capital is if your brand or message doesn't do both of those things, I mean, dude, you can't even get elected to the presidency without half the country hating you today. Okay.
That's great.
So,
Yeah, good
you
point.
know what I'm saying? So, like, you can't raise money trying to speak to everyone, and
Yeah.
you're not going to raise money from everyone. And so, pick a niche, pick an audience, figure out their pain points, and go deep there.
Yeah, no, it's a great point. It's interesting. Quite often I've been running my podcast now for 11 or 12 years, and I get a lot of people that reach out that want to start, over the years, they want to start a show and they're like, well, I want to talk about this, but there's, now there's 1,000 other podcasts that have similar
Yeah.
topics. I'm like, that's fine. I was like, you're not going after everybody. You're going after your subset of folks that they resonate with your voice, your background, your beliefs, who you are as an individual, how you say what you say. And if it's 100, if it's 150, it's a two, whatever, no, it doesn't matter. Right. But I can guarantee you there's folks out there that are waiting for you to do that, to get there and speak and preach your message, whatever it might be. And that's all you should care about. Don't care
Yeah.
about the other, 350 million
Yeah.
people, right?
Well, yeah, because it builds, right? I mean, I could tell, like, I mean, we used to coach capital raising, and I would just, there's so many great stories I can tell you of guys, raising their first million by speaking to a niche. There's guys raising, we work with 30 fund managers here at Aspen. I mean, we got a guy, man, who raises, um, I don't know, he's probably raised 60, $70 million from pilots. It's like, you
Yeah.
know what I mean? And he probably won't be with pilots for forever, but it's been a pretty darn good foundation for him, that now he can build upon and kind of go into other stuff. And I think that's really significant. There's another guy with Microsoft, and he only worked with Microsoft execs, folks who've been, and that's who he reaches out to. He can he can find the people that have been in Microsoft for 20 plus years, right? And then he goes and has a conversation with them. And because he spent 20 years at Microsoft, he has shared language, he has shared values, he has shared experiences, and he's raised a lot of money from those clients.
Yeah. Yeah.
And I think that's the point.
So talk to me about the transition. At some point, as of recent, I know that you made the
Yeah.
transition over to Aspen Fund. So I guess talk to me about kind of making the decision to um, not close down your investment shop, because you still have a number of assets that you guys own and
Yeah.
manage and oversee, but really stepping into a role of VP of Capital over at Aspen Funds.
Yeah. I mean, I think there's a couple of reasons, from a economy standpoint, multifamily was really is really hard. And a lot of things have slowed down there. And so I think it was kind of going to the drawing board and asking myself the question, what do I really want to do next? Right. Like, am I gonna I think I saw, and even kind of being in multifamily, like everything has its day, right? Like, and this is, I mean, I follow guys like Sam Zell, like real estate is cyclical, right? And so there's always something that is making money in real estate. But for example, if you're only focused on multifamily, then there's going to be times when it makes money. There's going to be times when it's probably not a good time to buy.
Yeah.
And so I realized that, and one of the mentors for me, or one of the companies that I followed and respected, was Aspen Funds. And the story of Aspen, they spent a decade, literally a decade, doing one thing, which was mortgage note investing. And so they've had an income fund which has paid 9% for 10 years, every single month. They've never missed a payment. And the track record and the trust that built, and the cash flow that generated for them, the company, allow them to expand into other asset classes. And so I saw that early on. I was like, that's really what I want to go do. I want to build kind of a basis of like an asset class that is constantly can generate income, and then allow me to go and expand into larger equity type deals. And so really it was just a question of like, do I want to go do this on my own, or do I want to go do this with someone else? And I've known the Aspen team for a long time. Those are a couple of the guys that I bought multifamily deals with in the past year. And so we started having conversations, and long story short, what I really cared about is I want to be a part of something big. And sometimes it just makes more sense, man, to build upon some, like, there's a couple things here. I think it's easier to go from 0 to $100 million of equity than to go from 250 million to $1 billion. So my point is, what I said, it's harder. Sorry, it's harder to go from 0 to 100, which is if you're starting out, right? So if I was going to restart or do something different, the amount of risk, the amount of effort, the time it takes from go to 0 to 100 million is insanely tough. You know this.
Well, it's
Aspen
like
today already
starting any business, right? I mean,
starting
any
any
business from
business.
scratch. Yeah,
It's
absolutely.
insanely tough, insanely expensive, insanely risky. And the chances of you being successful are very slim. Um, and so looking at what Aspen's done, they're already at 250 million. I know how to grow and scale. I know how to promote. I know how to bring folks in. And so it's just the opportunity of like, man, being part of a larger platform, coming alongside of them and again, mutual value here of what they could bring to me and what I can bring to the organization. And so that was it, I think, and I'm really excited about this run and the opportunity we have here um, to help serve our current investors and bring more investors in and really build what we want, a really unique company here in the alternative investment space. I mean, there are a few companies like Aspen that are, our model is not, say that we don't really have a specialty in terms of an asset class. Our specialty is identifying macro trends, and
Mhm.
then when we identify a macro trend, we will go and build kind of a strategic business model around that trend. We will put together a best in class team, and then we'll go operate the business model. And so that's what we do today, right? And so we have investment opportunities in multifamily, oil and gas, private credit is a big vertical for us, and industrial are the things that we're focused on.
Okay, good deal. No, that's exciting, and I know a little. I mean, I've known about Aspen funds for many, many years. Why don't we talk about oil and gas? I feel like
Yeah.
that's one of those niches that I mean, there's other folks out there that all ultimately offer oil and gas investments or in the space, but I think it's a lesser known investment class than that of traditional real estate, which is what we talk about all the time on the show. And so, um, is that where you're finding the best yield today? Is that where you guys are really putting the big emphasis, with your investor base and kind of your message?
Yeah, so it is by far our best performing asset class. 2024, it paid 15% cash on cash to investors. And that
Hmm.
was and we closed that fund in 23. The first assets were purchased in 23. And so in 24, we had a great year. I mean, oil prices were pretty high in 2024 as well, so that definitely contributed. From a commodity pricing standpoint, helped with that. But it is definitely continues to be our best performing fund, and so we just launched our fund 7, which we do not have any assets in yet. But yeah, fund 6 is our best performing fund.
Are you buying just the mineral rights, or are you buying the land itself as well?
Yeah, so yeah, our model's a little bit different. So, when most people like, how do you even cash? Like most people, think oil and gas, they don't
Hmm.
even think about cash flow because most of it, most of the oil and gas
It's
opportunities you see
exploratory, right? And just
exploratory,
high
right?
risk and good tax
It's
write-offs, but
exactly like think about it. Like it's so high risk, the government is willing to allow you to take the losses and use them against active income. That's what most of the oil and gas opportunities are, and the government is giving you incentive to go do that. That is not the focus of our oil and gas investment because that's not really what, like, our whole model here at Aspen is not really that. It's not really our investor base. We're more kind of value driven, cash flow driven. And so what we do is we go and purchase non-operating working interest across hundreds of wells at a time, which means we get the opportunity to participate alongside institutional, kind of large publicly traded type companies, and then we have the ability to what we call non-operating working interest, which means we're not the ones kind of doing the drilling, but we participate in the cash flow, we participate in the depreciation. And so what we're buying into, typically our model is we'll go let's say we go buy non-operating working interest over 800 wells. Well, there's already going to be production from those wells today, and the cap rates are pretty high. I mean, for example, that's how year one we're getting 15% cash yield, is because there's production from the wells when we buy. Think about like a stabilized multifamily deal, right? You're buying into revenue today. It's what we do when we go purchase these assets. But then there's also the ability to do future drilling, right? And so there's the opportunity to participate. Although what's nice about the non-operating working interest thing is that we don't have to participate in everything. So like a company can say, hey, we're going to be doing this drill. Do you want to participate? And we're a small piece. So maybe we're 3, 4, 5 percentage points of that well or of that drill. We have the opportunity to, take our cash and go participate in more production. So our fund, the goal of our fund is to increase cash flow year over year and increase value of the fund year over year. And so that's exactly what we do. So yeah, so it's a little bit different where we're buying into existing production, and then we're, over the years we're within that same asset, buying in or investing into more production through drilling opportunities. So
What's
that's
the
what we do.
long term? Yeah, what's the long term durability of these oil and gas investments? Using your model, I mean, what I don't know too much. I don't know hardly anything
Yeah,
about
yeah. Well,
the space. I mean, how long does a particular well? I mean, can it produce for 10 years? Is it typical that it's a year? I mean, like, can it go for 50 years? Right?
yeah. I
I
mean,
don't have a
there's
general understanding of the durability. A multifamily building can continue as long as it's maintained, doesn't burn down. Right? It could be 150 years old and still producing income. And so help me understand when I try to compare apples to apples there. If someone that doesn't have any past experience investing in oil and gas, it's understand the investment, the risk reward profile,
yes.
and just set expectations.
Yeah, great question. And first off, let me back up. Just people are like oil and gas. Um, 80, like out of all of the fuel that's used today in the world, 83% is carbon. Okay, meaning like carbon fuels is coal, natural gas, oil. Okay, so from a supply and demand standpoint, like oil and gas isn't going anywhere, right? So if you got in a car today, a plane, like anything, we're still using carbon fuel, right? So from the supply and demand standpoint, like this is when we say macro trend, the the demand for oil and gas isn't going anywhere, and the supply is and I can show you charts and stuff, is actually not necessarily increasing at the rate where demand is because of how much institutional capital is pulled out of this space. And so we see that as a great macro trend. But to your question, from an actual drilling standpoint, yes, there is kind of when we go look at an asset or the team that we partner with, kind of every well has a value on it. So they may say this is 10-year, 20, kind of 30-year value. And so it's not like multifamily where um and I guess in some ways different vintages are worth different prices, right? You could think of it like that. But absolutely, I mean, that's why, there's depreciation, which is just the amount of depletion on that well each year, and we get to write that off. But absolutely, I mean, these things have you can kind of think about it in the beginning, the production um is high, and then it kind of levels off for a long time, and then it's going to kind of taper down at the end of its life cycle. And I really can't tell you, depending on what the rig is, what the drill is, how long that life cycle is. It could be 10, 20, 30 years. But that's really what we're looking at when we go. I mean, we're looking at each individual well, and depending on how old that drill is or how old that operation is, it's going to have a different value,
Yeah,
right? And
understood.
so, and again, and it's really based on production. How old is that? How much production is happening? And then there's a value placed on um, each of those different wells. And so that's how we value that.
Understood. Understood. Okay. Well, I think that kind of answers the next question I was going to ask, generally speaking, because it's more of a per well. But I was going to ask, I guess, just is there like a break even point when you guys are underwriting these maybe individual wells? Is like, is it a price per oil has to sell for X price per barrel or
Yep.
higher, right? Like, is there a break even point or
Yeah.
threshold to where it's actually producing returns or not?
Yeah. Great question. Yeah. I mean, our base, our I think when we underwrote this, like for Fund 7, for example, our base case is at $67 a barrel for oil, and then gas is different, right? So maybe gas is like $2.50.
Mhm.
And then our downside case is I think around $55 a barrel, and that's just flatlined, meaning like you know, base case $67 a barrel for
Mhm.
10 years, right? To hit our 7x multiple projection. Now, here's what I can tell you, and here we all know this. I promise you that oil will not stay at $67 for the entire 10 years. I think we all know that, right? That's not what we're saying. We're kind of averaging it out, right? Because we know commodity pricing has swings. And so there's going to be time, like even right now, oil prices are compressed. But the thing about oil is like the best solution for low oil prices is low oil prices. Why? Because no one's going to drill when oil prices go down. Why would they? Right. So what happens? Well, it creates a supply issue. So then what happens? We have to create incentive or things happen where then we need to do more drilling. And so then prices go back up. And so that's, I mean, the reality is when you look at this, the need for oil, it's not going anywhere. So we have to go drill it, right? We need more supply. And so, yeah, I mean, over our fund, that's why we say this is a 10-year fund, because we know there's going to be dips in commodity pricing. But we believe overall the trend is that oil prices have to stay, relatively high. We're underwriting $67 a barrel, for example, if we go purchase you know, uh, oil assets, that's where we're going to be, because
Yeah.
from a macro standpoint, we're going to need more oil.
Have you guys found it challenging, your typical, credit investor, right? That's looking for alternative investments, looking at, maybe most of their background's been in real estate. Now they're coming into this oil and gas space. It's a whole new world, right? Very different. It's not as necessarily, I can't, well, I shouldn't say it's not as tangible, right? They can't necessarily touch and feel it as easily as they
Yeah,
could a physical asset. I know that there are physical wells and things of that nature, but it's just different. It's a completely different type of
yeah.
investment. So what has the general sentiment been, from your typical retail investor, when they're starting to explore this space, and is it much more difficult for them to make a decision to invest in this type of alternative investment than that of real estate?
I know this is so crazy, Kevin, but this is um so last year we did not have an oil and gas offering. Okay. Um so we closed in 23, right? So 24 was kind of the first year of production. And we just kind of did some real estate stuff. We launched our private credit fund. And I think we, closed the year with about $50 million of equity raised in 2024. Today, when we launched our oil and gas fund in March of this year, we have 55 million committed, with about 30 million of that funded today. And so my point is, like, we will raise more from our oil and gas fund and be able to allocate more in oil and gas than we raised in all of 2024 for real estate.
Yeah.
And I think part of that is a couple of reasons. One, it is a great place from a risk adjusted standpoint to find yield in today's market, where a lot of folks cannot find that in real estate. I think second is that this is a very different asset class in real estate. It has a different risk profile. It's non-correlated to multifamily, for example, right? And so I think a lot of people want something that's non-correlated to their current investment portfolio. And uh, you know, I don't know, maybe it's President Trump and the exposure of commodities and oil and gas in our country, but I think most people are waking up to the realization that, the green energy narrative, although we all probably want to be using renewable energy resources, over the next 100 years, the reality of today is our need for oil and gas is not going anywhere. And
Yeah.
so the sentiment is like, this whole green energy thing. Yeah, I mean, it's great, but the idea that we're going to move away from using oil and gas, it's ridiculous. And so it's probably a good investment for, the next 20 years.
Would you say that if you had to, I guess, drop your investors that are investing in the oil and gas fund, if you had to drop them in two different buckets, one that's more incentivized by the tax benefits, and the
Yeah.
other side of the camp incentivized by, income and yield, which bucket is fuller?
In the oil and gas fund.
Yeah, in the oil and gas fund.
Yeah,
Yeah.
I think the oil and gas fund, because it's a longer term fund, like our private credit fund really attracts the pre-retiree
Well, no,
retiree fund.
I'm sorry, I should have been more specific. Of the oil and gas fund, which of those two buckets, they're looking for tax advantages or,
Yeah. It's really
steady
more,
income.
yeah. It's more, it's but the both of those buckets don't make sense for this. Like, I don't, it's don't put me in that box, Kevin.
No,
I
fair
guess
enough,
is
fair
my
enough.
point.
Okay.
In the sense that, like, this is more of a value driven investor who definitely wants yield, but I also think wants growth,
Hmm.
and they're okay with a longer time horizon and more risk. Because if they only want yield, then typically, like, something like the private credit fund has been more attractive, because it's a
Gotcha.
shorter term deal. It's 10 to 12%. They're not locked up for very long. And that's really for the pre-retiree retirees. What I've found in the oil and gas fund, it is typically someone who's still working, still has an active income. They're looking to diversify. They're okay to kind of put some money away um, into a 7 to 10 year type fund for a big exit, right? I mean, they're going to get cash flow along the way, but we're really in this to, have the potential of having a 7 to 10
Yeah.
equity multiple. And so
Got
that's
it.
that's typically the investor in this. Like I said, it's someone that's still kind of in the middle of their career, is investing in this type of deal. Where I would
Understood.
say a lot of folks that haven't invested in this are like, hey, man, I don't know if I'm going to be around for 10 years. They're like, I don't think I'm going to invest in this one. So that's the difference.
I got
But I
you.
would
No,
say this
understood.
from a tax standpoint, it is a really nice asset class for a couple of reasons. One is we still get to write all the drilling cost. We still get to write off all the depletion cost. And the IDCs, there's no recapture tax on that. And so that's different than real
Yeah.
estate. When we go to sell the fund, we don't have to pay the recapture tax on the IDCs, which is the intangible drilling cost, which is the majority of the depreciation that we pay. So although we're going to generate more income than the depreciation, meaning you're going to pay taxes, on this fund, it's very tax efficient because we are kind of offsetting a majority of that income from the drilling cost and the depletion, which we don't have to pay recapture tax on.
Yeah.
So it's a very advantageous way to generate income from
Got it.
from this investment.
Oh, no, that's great. And Ellis, appreciate it, buddy. I guess for those, I just want to be conscious of time here. For those that have an interest in learning more,
Yeah.
talking to you or reaching out and just getting more information on any of the different investment vehicles that you guys have available, where's the best place to reach you?
Yeah, I mean, aspenfunds.us is going to be the best place to kind of go. We have an offering page, an investor club. At this point, we really only kind of send out stuff to folks in our investor club. And so just go to our website and join the investor club. My personal email is ellis@aspenfunds.us, and would be happy to connect with anyone listening to this show. But those would be the two places I would send folks.
Awesome. Well, good deal. Well, Ellis, this has been fun, man. Appreciate you coming on. I know it's been a long time coming, but we're finally here. So, just great conversation, great insights that you shared. And again, folks, we'll put all that information down in the show notes. But with that, my friend, I'll let you get back to your Friday afternoon. I appreciate you coming on the show.
Kevin, thanks so much, man.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.